This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
Information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 206 for Wednesday, 31st of May, 2017. US stocks traded slightly lower after the long weekend. The Dow Jones fell 0.25% and the S&P kept to its tight range, slipping about 0.1%. Paul Singer, founder of mega hedge fund Elliott Management, suggested the outlook for US stocks was bleak and he'd raised $5 billion to put to work when the markets collapse. He cites the unravelling of the Trump administration, which will lead to recession, and with interest rates at significant lows, he suggests the Federal Reserve will not be as effective as what it was after the GFC. All that said, the trend remains firmly up and many other indicators suggest momentum remains steadfast. Tesla stormed to new all-time highs, adding 3.1%, and Amazon nudged the $1,000 mark for the first time, up over 100% in just the last 12 months. China came off a two-day holiday today and Dalian iron ore futures promptly took a dive, weighing on the big Aussie miners. Banks held themselves well, at least initially, and indeed look set to bounce after recent weakness during May. We'll discuss shortly in some more depth, but NIB also popped back after yesterday's losses, and Nine Entertainment was also a standout performer, adding a little over 5%. Kidman Resources, a small cap we discussed in this podcast a month or so ago, has been travelling nicely in recent weeks but jumped over 15% and it stamped its name on a new trend higher. New Hope Corporation and Hutchison were late decliners, both falling over 11% into the close. And at the final bell, the broader market finished May with its worst performance for over 15 months, down around 3%. Today's session tried to get going at one stage and was up 0.3% but failed to hold, and it closed about 0.1% up on the day. Across the sectors, energy fared the worst, falling 1%, and REITs was the best performer, adding 0.6%. Taking a look at some of those banking stocks, they were smacked down during May. ANZ lost 14%, National Australia Bank down 11.5% or 11.3%, Westpac fell 12.4%, and CommBank weaker to the tune of about 8.2%. All the majors fell to solid support, which extends back to major zone of resistance that held them back for much of 2016 until the late year breakout. ANZ is technically the strongest in terms of relative strength. NAB and CBA have, to date at least, held that support, and Westpac is the weakest across the four. Most have now retraced 50% of the 2016-2017 gains, but importantly, this retracement has taken shape in an impulsive manner. What this means from a pattern progression standpoint is that May was the first leg of a three-wave pattern. The second leg, which may have started today, suggests a solid near-term bounce will unfold over the coming 3 to 4 weeks. For the larger bullish trend to remain steadfast, we'd like to see a slow meander higher and perhaps retrace a significant portion of the losses just made during May. This could then be followed by another sell-off, and it's after that secondary sell-off that we expect a very strong buying opportunity. And Coca-Cola Amatil has had a difficult few months, losing about 16% after a profit warning in April. Analysts are undecided as to whether the profit warning was an emergence of a structural decline in the company's core products or short-term hiccup due to adverse sector headwinds. Either way, it spooked investors on April 21st when the stock plunged over 10% on the day. However, there's a few reasons to remain optimistic over the longer term. First up, management should still be able to achieve stable margins and slightly higher pricing after the closure of a South Australian bottling plant, and also a $100 million cost reduction program is underway. Technically, we expect that the immediate downside may have completed and the stock is posturing for a bounce. There's some type A bullish divergence. One of the strongest short-term reversal signals that I've ever come across is now in place. Importantly, this signal is also aligned with a moderate line of support that extends back to early 2016. And when we get an area of confluence such as this, the probability of follow-through tends to increase. So at this stage, we're only expecting a bounce, but a low-risk opportunity is available, and that might be appealing for a trading opportunity for shorter-term traders. Check out our newly revised short-term trading area, the ASX Power Setups, for full details on that specific trade tonight. If you like what you hear on the daily podcast, I'd appreciate if you could leave an honest review and give us a rating on iTunes. Good reviews mean we reach a wider audience and you'll encourage us to keep producing this very free podcast. My name's Nick Radge. Thanks for listening, and I'll see you on the charts tomorrow.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.